All right, good morning, everybody. We're live. We're live. We have a guest today. This is going to be a fun one. My friend Rob is going to be joining on. He's in the waiting room right now. We'll bring him on. Rob's a mortgage broker in Ontario, and we are going to talk about mortgage rates today. That would be probably the best bet. I think there's going to be a lot of questions maybe from people on this. We'll talk about that, and then we'll talk about any kind of try and answer any questions that you do have. We have the regular people here. Let's before I bring Rob on, we'll just say good morning to everybody. Candace is going to try and make it. Candace, hopefully you're here. Welcome. And Abigail Bailey. Good morning, Abigail. Welcome back. And Stan is here. Good morning, Stan. So welcome. Let's just we won't keep Rob waiting. Let's bring him on, say hi, and we'll go from here. So I think Rob's still muted. We'll unmute, make sure he's unmuted. There we go. I
There we
unmuted
go.
him, muted him back. And let's go. So topic of discussion. I was on a live. I was on actually Candace's. Candace is one of the other YouTube channels I follow. She does live streams, Rob. And there was people talking about. Kind of came up towards the end of her stream, and someone came up talking about mortgage rates. They have a mortgage for renewal. What do I do? Obviously, the channel is that I have here is we talk a lot about finance, but mortgages are tied into that, right? I mean, not everybody has a mortgage. Some people rent, but it's obviously a topic. I think with rising rates is on everybody's minds right now. So I guess the biggest question that people were having that I came across, and we can if people have questions in the chat, shoot them out. This is what Rob's here for. We can try and answer them the best we can. Was basically I've got a mortgage renewing either now or in the very near future. What do I do?
Okay. Well, first of all, good morning, everybody. Thanks for inviting me on, Scott. I'll let you ask the questions when they come into the chat. And I first want to say, as I always do, even on my own videos on YouTube or any stuff that I do, this is not financial advice, right? This is purely discussion. Don't listen to me. I'm a moron. Don't worry about what the awards might say otherwise. So everybody's situation is obviously unique to them, right? And they're one thing that homeowners that we talk about all the time is, as we saw with the last 2 years, you can certainly make a plan, but sometimes that plan is a moving target, right? As Scott, with a lot of the investing stuff that you talk about, I'm sure, what's the end result? Well, the goal is we want to get to X amount of dollars or retirement or whatever. And along the way, those plans kind of zigzag as you go, such is the case with strategy when it comes to mortgages, right? So this is the token question we get all the time is, what's the better option, fixed or variable? And if we say fixed, then most people default right over to a 5-year fixed mortgage. Reason being is it's the product that's always been sold. It's the product our parents have had and our grandparents and whatnot here in Canada for sure. And the thing about pricing right now and uncertainty in the market is, we'll talk about pricing first. The short-term rates are actually not that much cheaper than a longer-term rate. So a 5-year fixed right now, let's just say it's 5.5. It's not 5.5%. It might be a little lower depending on the property and location and all that. But let's just say it's 5.5% on a 25-year amortization. If you opted for a 2-year or a 3-year, which might be a better strategy. Again, this is not financial advice, but a lot of people out there believe that we are somewhat at peak mortgage interest rates, where we might not be there quite yet, but we're closer to the top than we are to the bottom, right? Because we've been in the bottom for quite a while. And some of the strategy out there that people are talking about is, well, maybe we try to take a shorter term to be able to, like almost an investments type of view, dollar cost average your way down in 2 years. So what that means is, instead of locking into a 5.5% fixed rate mortgage today, maybe you take a 5.4 or a 5.3% mortgage today on a 2 or 3 year fixed, and then just hope that your strategy pans out, and maybe we're in recession and rates have come farther down.
Back down.
That's right. In the next 2 to 3 years, that's not a guarantee. We might see locking in on a 2 or 3 year rate at 5.3 or 5.2% today.
Well, and I've even seen, looking at some of the banks, looking at the rates, the shorter term rates on 1, 2, 3 year terms are actually higher
Yeah.
than what they're offering. Now we can talk about posted rates, whatever discounted rates, but just if you go to a website of a bank, of any bank, you're probably going to see higher rates for a shorter term. So it's like, that's the whole hard part that I think people are having a hard time to decide, right? Because
Yeah.
do you lock into 2 year that's more like, there's that whole, the mentality, I guess, is always like lower is better, right? And that's the hard part with strategy, is looking at it going like, okay, I might pay a little bit more in the short term, but will
That's
this
right.
even itself out? And that's the hardest part. And
That
I
is the
guess,
hardest part.
this is, I guess, the first question from Zion came in. Hopefully you can see this, Rob, but should
Yep.
you switch to fixed now? When do you anticipate rates to go down? I can start a little bit on that in terms of what rates, because we talk about it on the channel and on the market, and we're kind of thinking this is the big crystal ball.
The
Nobody
big
knows.
million dollar question. That's right.
No, nobody knows. If we're talking about variable rates that are tied to prime rate, all indications pointing they're still going to go higher. So when are they going to come down? Nobody knows. That I'm kind of thinking early 2023, but I could be completely wrong.
Yeah. So I'll answer that rate question. Sorry, the rate question was, are they going to come down? Right.
Yeah.
So
Should you, the question was, should you switch to fixed now? When do you think rates will come down?
So the thing that everybody has to remember about switching to a fixed rate mortgage is, if you're currently in a variable and let's say you're 3 years into your variable and you've got 2 years remaining because it's a 5-year term that you've taken. If you started off at a 25-year amortization, you're going to be locking in at a 22-year fixed rate amortization. Okay, so what you really need to do is figure out how many years you have remaining amortization wise, and do your new fixed term off of that amortization, because that's how it's going to get locked in. So there's going to be, it's not dollars to, apples to apples when you're talking about just a conversion from variable to fixed, because your variable is based off of a 25-year or whatever it was originally
If you're
at.
switching it, right?
That's right. I would say if you're at an institution that would allow you to fix in at a smaller year, I mean, so let's talk about that. If you're currently on a variable that's, for all intents and purposes, 5.25 today, okay, that might be a little high, but it might not be, because if you took a bank posted variable mortgage, it's not a deep discount. So let's say you're at 5.25 today and you want to lock in. Well, you're going to be locking in at 5.25 or 5.5. So what the question you have to ask yourself is, how much farther is the Bank of Canada and the Fed going to keep going? I agree with you, Scott. I think it's going to go up yet in December. And then are you okay with being locked in at 5.5 or 5.25 as variable, as the overnight rates potentially starts to come down? I don't think it's going to come down in 2023. I think we're going to be fairly flat in 2023.
Yeah, and sorry, I guess should probably clarify when I say stop. I mean, I kind of think mean more of a pause, and I think
Right.
a pause. I think a pause is as much relief as as a discount almost.
Yeah, exactly.
For people, but there'll be a
Relief,
pause,
yeah.
a relief in 2023, hopefully.
Yeah, I agree. 2023, I
wish I had
have to
I wish I had a
predict.
crystal ball.
If I would have to predict, and I'm kind of getting tired of making predictions because they've all
it's
come up
impossible.
wrong. I would say that rates are going to stay fairly flat in 2023, with a potential of them to start to get eased in 2024. Now, it all depends on monetary policy, world economics. This is something Scott and I talk about off
Stuff
camera.
way over our heads, right? Like a lot of times.
Right.
So that's the
That's
hard part.
right.
It's
liquidity, and oh my God,
it's so hard, I guess, for people like I mean, I don't have a mortgage anymore. I was always a big, and we've talked about it, and I've always been a big variable person. But going now, you kind of have to think. I would be like, personally, I would probably, I would lean towards. And we were talking like in a question, like, what do you choose? And I don't know if it's necessarily a good time to lock into a 5-year term,
right?
Because you're locked in for 5 years.
You're locking in kind of at highs already.
And I'm speaking for myself. I prefer I'm obviously, as an investor, I'm a bit more risk tolerant, and I think it probably maybe is the same with if I was when I had my mortgage with variable. That being said, I always had my payment higher than what my payment had to be, so that's a completely different, prepayment issue. But I and you hear, like, you always hear you read the horror stories, you see the horror stories of people with penalties, right,
Mm,
with 5-year terms.
mhm,
So the variable kind of offsets that if anything kind of has to happen. You have to move. I mean, we all know life happens, right?
mhm.
And there's a reason that you might have to sell your property. And if you're breaking a fight like a longer term fixed
Mhm.
mortgage, the penalty can be quite substantial.
Mhm.
So I don't know.
Yeah.
There's no good. I think the answer is there's like no good choice because no one really knows what's happening next
I
week, let alone
I
6
would
months
think
from
that
now.
prepayments I would think that prepayments should be on everybody's mind. No matter which strategy you go for, whether it's a 2-year fixed to stay in a variable. I know times are really tough for a lot of people, but how you're going to chip away at that rate without changing the rate, or letting the market change the rate, is prepayments. Like, the more you're able to squirrel away, and that's easier said than done.
Yeah,
As we saw our brilliant finance minister talk about canceling their Disney Plus subscription. Um, I think that every little bit that people can put away towards their prepayments in their mortgage is going to only help them
down the
10,
road.
5, 10 fold down the road. And it's going to effectively lower your current mortgage rate behind the scenes because you're paying less interest
Yeah,
on that debt. And again, that is easier said than done. But, it's the analogy that I use is the Shawshank Redemption should have won an Oscar over Forrest Gump. I mean, Forrest Gump's just garbage, but whatever. Um, Andy used that tiny little rock pickaxe. It was like just a tiny little pickaxe, and every day he started to chip away the wall to break out of the prison. That's literally how it feels when you're prepaying your mortgage at 100 or 125 bucks a month or whatever that small amount is. You kind of feel like this is useless. This is not going to get me anywhere. Every $100 you put away on current rates, you're probably saving $300-400 in interest over the life of the mortgage. So every little bit helps, right?
every
So
little bit will help.
it might not
Yeah,
help today, might not help on your renewal in 2 or 3 years, but 5, 10 years down the road, you're going to be farther ahead.
yeah.
Much like that whole compounding interest idea, just as a kid, like when you're squirreling away money in your savings account and your investments, it doesn't seem like $10 a week seems like nothing. $100 a week seems like nothing. But when you get to 45, 50, you know, there's a
It
huge, huge
It
difference
definitely
there.
it definitely adds up. Now we have a question. It's a little bit not quite on mortgage rates, but it's mortgage related. I'll let you start off in this answer, and then I can give my 2 cents on this. So, someone's thinking, maybe is it using a HELOC? So for people that aren't watching, don't know what a HELOC means. It's a home equity line of credit. It's a line of credit that's tied to your home, which usually gives you a bit lower rate. But the rate does fluctuate with prime. So people's HELOCs rates have obviously gone up as Bank of Canada prime goes up. But to get into this question, is a HELOC the best way to buy a new investment property, assuming you can afford the additional payment, or save up, or is it better to save up cash over a period of time, which could take a long time? I'll let
Okay, I
you
will
answer
answer
that, and then
this. I
I'll
think
jump in.
I think in this current market, I think it's a recipe for disaster for most people to even be in that mindset of leveraging their home on a HELOC to buy an investment property for two reasons. Instability in rate increases. We don't know if the Bank of Canada is going to go 50 or 75 in December. We don't know if CPI is going to just stay through the roof and they're just going to keep going in January and March of next year. Too much uncertainty, right? And again, it
Yeah,
depends on how much cash you have on hand, what your career is. Like, there's a lot of ifs there. I would say generally this is a bad idea in this current market. And the second reason, the first reason is obviously HELOCs going up, and if there's liquidity issues, lenders could kind of turn those off, and there's issues there. Now, having said that, sidebar, HELOC interest is actually not that bad. It's simple interest calculated on a daily running balance, charged monthly, generally speaking. Very different than an amortized mortgage compounded semi-annually. It's a different type of interest charge. So it is better, however, very risky, especially in this market. Second thing is, I don't think we've seen the bottom yet on real estate. I think that there's going to be a lot of opportunity to scoop up properties in the spring that are just sitting around, because remember, The buyers out there are still buyers out there, but now they're stress testing on a purchase that, let's assume a rental rate today is 5.75 to 6%. Let's just call it 6% for easy math. You're now stress testing at 8%, whereas 12 months ago you're at 5.25 to stress
Yeah.
test that purchase. I just feel like there is still bottom discovery there on properties in general. If it's a great property in a great neighborhood, owner occupied, there's going to be competition and it's going to sell for today's fair market value. Investment properties, I just kind of feel a little bearish on that stuff right now, especially if you're getting in with a HELOC and especially if rents are through the roof and you get a tenant. It's going to take one bad tenant, 2 to 3 months of heartache, and that you're in the
Enough.
red.
Yeah, and that's my answer too. I mean, I'm not. I'm a definitely any type of, and I've talked about it on the channel, like any type of investment using leverage, I'm just not into.
Yep.
And people, I think, forget that. I think they kind of forget that when they're
Yep.
using a line of credit that's kind of tied to their house. They kind of almost treat it like, oh, it's just it's equity, it's free money, and don't realize, if we look back, what were the home line credit rates, or what, prime plus, let's say prime plus one.
Yeah, let's say prime
So
plus one. So
six months, they went from
3.45
3% ish to,
6% ish, six and a
right.
quarter, or actually no, higher,
Yeah,
6.95 right now.
yeah. And
So
if
almost 7,
Yeah. And
right? So
if you're using that to buy a rental property, rents haven't gone up. You buy a rental property with a line of credit, your renter's paying market rent, but then all of a sudden your rate goes up, what,
3%,
three,
three and a
four
half
percent
percent,
almost.
three and a half
And
percent. Yeah.
your rent's not gone up that much,
Yeah. And utility, another thing to consider is
utilities,
utilities, right? Maintenance
insurance,
costs. Let's say your tenant, and I understand that we're painting obviously like the most negative of
right.
extremes, but this is real life. It takes one bad tenant to not pay for 3 to 6 months. Google that. Like that's happening now a lot. People 50, 70 grand in the hole for not being able to kick out tenants. And then let's say the last day before you get the sheriff to show up and kick them out after 6 to 12 months of not paying rent. They just demolish the place and off they go. So now you've got to get a tradesperson in. Trades are not cheap. Like, it's
Yeah.
it's not as easy as that beautiful haired HGTV superstar likes us to believe that it is.
Yeah.
So the short answer is don't do it.
Yeah. I,
That's my short
I
answer.
think I think we're both very bearish on the rental market. I think, especially, people still have to move, right? Families are still growing. People have to
Yeah,
upsize. People have to downsize because they're getting older. So
sure,
the market's still going to move,
sure.
but I just don't think it's necessarily a great time to buy a rental
Yeah,
for the
I agree.
heartache. So Zion has kind of commented. Here's another good question. Pay a lump sum, and I'll probably have the same answer as you on
Ooh,
this one. So pay a 50K lump sum on current mortgage, or use to book a pre-construction on the current market. So a few things on this. I'll start off with the kind of thinking on an investment idea. Depending on your mortgage, number one, you may be better off if you're hanging on to a rate that is paying, you might have a 5-year fixed rate that's 2% on your mortgage. It doesn't necessarily make as much sense to pay that off these days, because you could actually take that 50,000 and put it into a GIC,
at
and there's
five,
there's
six
G there's
percent.
GICs paying just over 5% right now.
Yeah.
So that's one option on the investment side to think of that, and that's why I think a lot of people are thinking of buying investment properties and stuff, because the rates were so low. It's like free money, right?
That's right.
That
And the
those
market was
days
on
and
fire.
those days are over. So I don't know your thoughts on that.
I like the idea of prepayment if so, people have to remember that your mortgage is kind of like, if it's not set up properly, it's kind of like the old school piggy banks, like the little owl piggy bank over my shoulder. Now, this owl has a bottom that can come out and get all the money out. But the old school piggy banks, you would literally have to smash with a hammer to get the money out. That's your mortgage if you don't have a HELOC attached to it, or an automatic readvanceable HELOC. And all the banks have HELOCs. Manulife has a great product. So another thing, this is not financial advice. Do not listen to me because I'm an idiot. Another idea is, why not, if you again, you got to do the math on how much money you owe, the interest rate on your mortgage. But if you have extra cash, you could actually be in a situation where you make a massive prepayment to the mortgage. It then becomes a limit increase on your home equity line of credit, which then you could potentially borrow and make on long-term investments. So the reason is, if you make that investment on long-term investments using Canadian equities, you could run into a situation where you could actually write off the interest on the HELOC. This is very risky because you could
Yeah.
lose all of your investment money and still have a HELOC debt to pay off. But if it's done properly, you may be in a situation where you could do that. Again, as Scott said, if you have a fixed rate mortgage of 1.89%, you're going to save. I ran this math last year, on a 2% mortgage, every dollar you put in as a prepayment, you're going to save a dollar in interest. So you have to ask yourself, if the rate's really low, does it even make sense to do that? If your rate's high, it definitely
It
makes sense
does.
to make a
Yeah.
prepayment. If your current mortgage rate's 5%, I mean, that makes sense to me to actually put the 5K, 50K in, make a massive prepayment, have that prepayment principal moved over to a limit increase on your HELOC, and then maybe use that HELOC for long-term investments, like, you know, really safe stuff, because you're writing down, you're paying down bad interest, and then you're leveraging good interest at a daily running, a simple interest calculation to make a Canadian investment where you could possibly have, the Smith maneuver kind of
Smith maneuver,
style,
right?
right? But
Yeah.
that's a very, very,
I
very
think it's risky.
risky
I
investment
think it's risky for the average person,
for the
right? It
average
sounds
person.
great on paper
Yep.
until you actually get down to it.
Yep.
It can be, I think. I mean, it is for me. I can only speak for a lot of it myself. It would scare the hell out of me. I don't do any investing at all on any type of leverage. So
Right.
I'm not smart enough. It's basically what it is. So, um, and there we go. So, good morning, Zach. Just a regular Zach. Zach usually joins. He's the one that wears the tie all the time.
Oh, nice.
Yeah. A question from Nadia.
Nadia. My goodness.
You might have to do a bit of explaining what a B deal is, Rob. I'll let you explain that. For a B deal, would you suggest a 1 or 2 year term?
Ooh, that's a
So
really good question. So I'll first explain to the audience what a B deal is in mortgage broker speak. It's an alternative lender. So you have prime lenders like your big six banks in Canada, and all sorts of mortgage broker lenders that are issuing mortgages at, AAA rates, right? Great credit, no debts, great employment. That would be your prime lending. Alternative lending, or the B lending space, AB, is, bruised credit. Maybe it's really hard to verify income. Maybe you're a sole proprietor and you gross 100 grand a year, but your NOAs show that you only claim $10,000 a year, but there's cash flow in your business. Like, there are alternative lenders that'll help you with mortgage financing. The rates are crazy enough, only slightly higher than what conventional pricing is at A lenders or prime lenders. But the caveat there is there's some more added fees, right? There's a lender fee, there's a broker fee, and they're not as long of. So Nadia's referring to not as taking a shorter term, because generally speaking, alternative lenders will deal in 1 to maximum 3 year
three,
terms, right? So the question is, should you take a 1 or 2 year term when you're with an alternative lender? And exit strategy out of an alternative lender for most people that are going into an alternative lender is really hard, because generally speaking, most people are going into an alternative lender because of income verification or credit. And credit's something you can repair, right? Credit's something that you can get better at, fix up your faults. Maybe a 2 year term is going to give you that 2 year clean history of repairing credit to get you back into that prime lending space. Generally speaking, self-employed customers that are going into alternative lending, they'll have a really hard time with claiming more income on their taxes to get them provable income out. So they'd rather not, and then they're perpetually into that alternative lending space. I mean, I really think it depends on the situation, right? But to take a 2 year term right now isn't that much higher than, in an alternative loan, is not that much higher than conventional loans anyway. It's probably half of a percentage point higher. Yes, there's fees, but if you solidify a 2 year term, and you're diligent with credit repair, and you're diligent with whatever it was that you went through to have to get you into that alternative loan, if you try your best and stay focused on getting out of that, maybe a 2-year term is not that bad. On the flip side of that, maybe a 1-year term isn't such a bad option because you could always
Yeah.
renew.
It gives you the flex. Yeah, it
You're
gives you.
just subject
You
to
look at
where the
it
market's going to be at that time.
like
So
everybody else, right?
A, B, it doesn't matter. It's
Yeah,
always like,
yeah.
where are we going to be at in a year? So, that's a really good question, Nadia. I think it does. It obviously, this because I know your line of work. It does come down to, um,
Each
the client each
each
individual is
individual,
kind of,
what the
yeah,
issues are of
yeah.
credit and that kind of stuff. Yeah, yeah, yeah. You can probably add to this one, Rob, because you are in Ontario. I'm only on the I'm on the West Coast, which isn't the center of the universe,
Yeah,
as
Ontario is
we
for
know.
sure.
So,
Yeah.
what's the year out? I mean, we obviously we see in the news new immigration. What 500,000 by like
Every year. I mean, just
is it every
every year.
year or is it like
Yeah.
yeah?
Well,
So by
they say
2020,
it's going to be like 4.5, K next year, but it's going to be higher. Like, I mean, so this is a really good question. I think we have a real big problem in Canada that Canadians are not aware of quite yet. Maybe they're going to feel that we've been riding this wave of low rates and easy equity gain in properties over the last 2 to 3 years. Well, actually, like 5 years, 5 to 10 years.
seems like
Yeah,
longer. Yeah,
yeah.
low rates.
Um, I think we as Ontarians and Canadians, we have to really be aware of the challenges that Canada faces in the next decade. And we have politicians and bureaucratic levels of government, and this isn't a. I'll keep this clean. I was about to swear, Scott. This isn't a blue versus red discussion at all. I think at bare minimum, people just need to get out and vote. Like the voter
Mhm.
turnout is horrifically low in Canada, but we all want to complain about stuff. Um, to talk about immigration, we Canadians aren't having kids. Like they're just we have a we actually globally, I think statistics show that we are actually on a population decline.
Decline.
Right. It's not a collapse because when you say collapse, it means like millions of people are dying every day, but it is in a decline. So is the planet overpopulated right now? Some would say yes, some would say no. But one thing that a financial planner said to me a couple of years ago when I was talking about immigration and complaining about the number of people coming in with the problems that we still have. I'm very pro immigration. I'm a product of 2 immigrants to Canada myself. So I'm very pro immigration. I feel like we're setting up immigrants for failure. If you talk to social workers, healthcare providers, um, guidance counselors in colleges and universities, immigrants are coming here being sold on the dream of Canada and paradise, like the land of opportunity, and they're coming here and leaving or falling flat on their face. And one of those things, the reason is because of the housing prices or rent, the
Housing
cost of
being
rent.
so expensive.
That's right. So circling back, GTA real estate, I'm actually bullish on values in the GTA and in Vancouver because the government can't, for the life of them, get a housing policy. I mean, Trudeau was voted in 2015 in part on making housing affordable. It's out there. YouTube it. It was one of their platforms that they ran on, and we're way worse off now than we were in 2015 when it comes to affordability. You could buy a home in my city, Guelph, Ontario, Guelph mortgage broker, Rob Campbell. You could buy a detached home in 2015, no joke, for $300,000. A detached 2-bedroom home, starter home, on
Mhm.
a 50 by 90-foot lot, detached home. Today, that same home would sell for 750, maybe 800, but maybe not that high anymore from the peak. So if you're coming here with very little in your hand, cash, and very little opportunity for careers and whatnot, like where are you going to live? Where is 500,000 people going to live? It's not happening. So this is going to create, I feel like it's going to prop up home values, which is great for people who currently own, but it sucks for people trying to get into the market.
Yeah.
So I am fairly bullish. Now, I want to be really clear. don't max out your HELOC and go buy 10 rental properties. I'm not that bullish. I'm just
No.
saying, like, your home that you live in right now is probably going to maintain its value from here on in. Like, it's not, the end of the world is not coming. There's a lot of bears out there that are like, oh, we need to burn the system down. It's not going to happen.
Yeah.
Not
No.
happening.
No. We'll see. We're seeing correction, I guess we'll call it. But I mean, prices are down substantially in some areas, but they should
They
have
are.
never got that high. It's like a stock, right? People were treating housing like
Like a
this,
game, like GameStop.
like a stock market, because you
Yeah,
see prices going in like this doesn't make sense,
it doesn't make
especially
sense.
especially in certain areas, right? I mean, outside of
Yeah.
big
Well, look,
cities and stuff like that, right?
with
We've talked about it a lot, going like,
with the ramp up of the prices, I was saying to people, last year and even in January, February, look, it's all well and fine that you'd be able to sell your home for $1.2 million. But if you actually strip apart your house, all the goods that are in the house to build it, not your couch, not your TV, I'm talking about structurally to build your home. If all of that stuff is only worth $500,000, you're telling me that the dirt underneath it is worth $700,000? That's crazy, right? So there's only so much a home should be worth. I mean,
yeah.
but anyway, that's for a whole different discussion.
And Candace is here, so talking about home and people not affording to buy, obviously, are renting. So rents will remain high. I can speak for that. As a renter now. Rents are expensive. Yeah, I won't lie. But there's also. I mean, I've also talked about it too. I mean, I had a property, Candace. I can't believe how fast time flies, right? When did I sell? Like 3-ish years ago.
2020.
It was 2020, and it rents. In thinking back though, the rent's actually not. It's actually not terrible compared to home ownership as well, because that's what people don't forget. Like, everything's more expensive, right? So I mean, I'm paying more rent, but I look back to what I was paying as a mortgage, and especially when you get a place that was starting to need work and need maintenance, and the cost of everything else going up, sometimes it doesn't, it almost, I don't want to say make sense necessarily to rent, but everybody has the reasons. I don't think renting is a bad thing. For me, it gives me flexibility, and I'm a big believe kind of, it works for me. Just from, as you know, like I used to, everybody on the channel knows I used to you live in another province, and renting gives you that flexibility, differently than home ownership. So it works for me, and I don't see it as a bad thing at
No,
all.
not at
I mean,
all.
that's the one thing with different, generations, for sure. Kind of look at renting as maybe frowned upon. Like my mom, I keep telling her she should sell her place and downsize, because she doesn't need a big house. And but they have,
Rents are currently astronomical.
yeah,
It's crazy,
especially in cities.
especially in cities. I mean, 18 or $1,900 for a 1-bedroom apartment in a high-rise building that's dated. It's not like a brand new building. $2,000 for one room and a kitchen.
Yeah,
Insane. So
it's crazy.
yeah, I mean, but having said that, in North America, we haven't gotten away from the mentality of you're a failure if you rent. Like, London, England, Paris, France. I'm sure not everybody's owning those flats that they're living in, because the costs are just astronomical. So yeah.
Hmm. Last question here. And if anybody else has any questions as we're going on here, if you have a specific question, like, by all means, fire it in the chat. We've got quite a few people watching. I know the regulars are here, and some new people. So fire a question in the chat. But MC, welcome back to the channel. This is a good question. I can answer a bit of this because this is kind of right up my alley, in terms of that. But Rob can kind of probably give his opinion too. So what is your opinion on investing through a MIC? Now, for those that don't know, MIC is a Mortgage Investment Corporation. So basically what you do is you pool of investors put in their money into this corporation, and they lend out capital as a mortgage. So my opinion on that, partly, is check the returns, MC, on what the MICs are paying. Now, I know in the and a MIC is, we've talked about earlier. We talked about A, B lenders. A MIC would be more of like a private. So that's kind of like C and D almost, not necessarily bad credit or anything like that. Just for whatever reason, it's people can't fit in to the A or B box. They usually go to a MIC or they'll go to a private lender. Check the returns on MICs. Check out if you're doing that. Check on how easy it is to get your capital out. If you are investing in mortgages, right? Mortgages are longer term. Obviously, usually a 1 year term in the private space. Sometimes two, not very often. Check out how easy it is to get that out, because what's happening, and you can probably read a little bit about this in the news, is there are certain MICs and mortgage investment companies where investors are trying to pull out the money, and they've actually stopped you from being able to pull out your money. So watch that, because rates have gone up, right? And people aren't renewing. So there's just a liquidity issue with some of those. Be careful. On the flip side of that, check the returns, because sometimes you can even get a better rate of return on, like it sounds crazy, but a better rate of return on a GIC right now. Or you could look at see some of the, obviously not financial advice, look at some of the other lenders that are traded. First National is one that trades on the TSX, which is a good one. You can also, is home
Capital.
Home Capital, Equitable Bank are a few of them you could also look into. Those are along the same lines, where First National is obviously on the A side of lending, but those other two are on the B side. You might get some similar returns to a MIC with maybe a bit less risk, not financial advice.
I will speak to this as well, because I just came from a conference where they had a private lender group speaker or mortgage administrator. So the risk that there's far less risk with again, not financial advice, far less. Don't listen to me, I'm an idiot. That's what I just say. I just wear that like on a shirt. Don't listen to me, I'm an idiot. With a MIC that's well run, okay, that's the key. Well run. Because there was a lot of crap going around in Canada with just loose money getting thrown all over the place for a really high yield. I mean, where there's smoke, there's fire. If you're looking for really, really high yields, then that's going to be high risk. Yeah. A MIC is going to be able to basically pool in the money with a guaranteed return to the investor. And if there's losses within that pool by ways of investments, the shock is absorbed amongst the company, its asset allocation, and the investors. So, they might be charging 7 or 8% for their mortgages, but they're guaranteeing you 5 or 6, right? There in that margin is their risk for taking on those loans. If you're directly investing in mortgages, very high risk, because you're taking your 50 grand and you're putting it out, you're rolling the dice on one mortgage that you are paying for. If they default, and if you can't take over the first, then you run the risk of losing all your money. So MICs are great to invest in if they're well managed and well run and have a good track record. So be very, very careful where you're investing your money.
I guess it's like any investment. Don't put all your eggs in one basket, right? Diversify.
Yeah, absolutely. Absolutely.
Yeah.
People who are very, very bullish on Tesla or Bitcoin or anything, whatever it is, like they're going to solely invest in that because that's the pill that they've taken, right? That's what they firmly believe in, and they're gonna reap the benefits if it goes to the moon, and if it all goes to shit, then if it all goes to hell, then they're going to lose all of their money. Or you could put it into a diversified fund that's spread out over 10 companies. One company goes down, just a little bit of a shock to your investment portfolio. So
that's a great question, IMC, because I don't think a lot of people have interest in that, right? As I see it. Question from Zach, and I'm not a fan. So he's wondering. This is a whole other topic.
Oh wow!
But rent to owns would make return with the return of like a 3D printed house, right? Cheap kind of modular kind of houses.
This is a great question.
Probably the issue is the cost of land. Yeah, land is expensive. Rent to owns, I have limited knowledge of them, but I know usually they don't really favor the people that are renting them. It's usually still favors the landlord, because people kind of get into these contracts that they maybe don't understand fully. So it's hard to know. But I do like the idea of possibly looking at these different types of housing for sure. I mean, that's the one thing we need in Canada is more housing, more density. I mean, how we talked about it. I think we talked about it on the phone the other day. It's like Canada is huge,
Huge. Well,
but we're all concentrated in such small pockets of it. So that's why everything is so. But there's no infrastructure anywhere else, and that's the whole other problem.
there's this
And
video.
it's cold.
And it's cold. There's a video floating around online about they built a Chinese train station in 9 hours. I don't know if you saw this
I saw
video.
that.
Okay. So there's a lot of dialogue on Twitter about, why is the QEW in Toronto an expansion of a couple of lanes taking 9 years to do when they can build a train station in 9 hours in China? Let's take away, because it's very important, but let's take away labor laws. Let's take away pay. Let's take away like all of that stuff that we immediately go to when we talk about Asia versus North America, right? Well, they don't pay them enough and they're working in horrible conditions and people are dying on the job site. Okay, I'm not discrediting that. But let's just think about they built a train station in 9 hours. There's other countries that there's videos of them building overpasses on highways overnight. Okay, so why don't we, again, this goes back to the previous question about, I'll get to the 3D printing in a second because that's really interesting and I know about that, so that's really interesting. Going back to immigration and housing and elections, like why don't we have high speed rail? Okay, there is snow, granted, but surely we, on a flat plane where maybe a snow clearing train goes ahead of it, or maybe the train tracks are up on a pedestal instead of on the ground. Maybe they're on, 5 feet off the ground. I don't know. Figure it out. Point being, why don't we have, pockets in the greater areas
In
where
areas.
you can go, look, you get a super train pass for $100 a month. It'll get you into the city. It'll take you an hour, but the train's traveling 300 kilometers an hour, right? So it super fast, super reliable. These are the questions that we need to start asking. Where are the plans for these? Like we're constantly building more highways. Scott, I just commuted an hour and 45 minutes one way to a conference yesterday and an hour and 45 minutes back. It was all country driving. It was beautiful. I hated life. It was still an hour and 45 minutes that I have to sit behind a wheel and stay alert. If I can get on if I could have done that trip in a half an hour and paid $50 to get there and $50 to come home, I would have done it.
Yeah.
So 3D printing, that's really interesting. I think we're going to see a lot more of that kind of stuff because it is structurally sound, because it's concrete pumping. If it's done properly with rebar and whatnot, it might be a great solution. People might think that's really hokey, but don't forget, we live in homes made out of toothpicks and cotton batting in the walls, right? Like if you buy a home from the 1960s, it's built like a brick, what house, but it's not like they were premium products back in the day, but they're still standing. So 3D printing is, it's effective. It's cheap. You could stucco it. You could just leave it the way it is. It doesn't really matter. If you're giving somebody a small bungalow to live in, maybe not a bad idea, especially if there's no driveways and it's all like commuter, like foot traffic to the train station. That's a 10-minute walk away. And it's like a super train going into the city.
Mm-hmm.
I'm pretty sure that there's a market for that. A lot of people would go for that.
Well, a lot of the places in the Lower Mainland that they built up around the SkyTrain.
That's right.
So there's no reason why, right?
Mm-hmm.
Stack it up. We need more houses to make it. More houses, obviously. Hopefully, we'll bring the prices down. We'll see.
Mm-hmm. Mm-hmm.
There we go. Well, we're coming to the end. These are always fun. We're 8:45. Thanks everybody for kicking in. Get your last minute questions in if you have. We did get on we always get sidetracked on these live streams, but I think that's okay. But we did answer, obviously at the beginning. What I guess in summary, do you choose what do you choose for a mortgage rate in 2022? It's like there's no good choices right now, and it's trying to pick the best one that's for you, which is probably a shorter. I think we can kind of both agree as a shorter. We're saying a
A
shorter
shorter
term
term
for this
because there's
time,
uncertainty.
and
Yeah.
short term pain hopefully will be a longer term gain. I guess is the one way to maybe put on it. But it's
Leave us a
yeah,
comment down below right now so we can see it. Did we did we do a good job? Give us a thumbs up, thumbs
a thumbs
down.
up,
Give
thumbs
us some
down.
feedback. I always like to get a little bit of feedback. Look, I got my
Yeah.
Christmas tree. In the meantime, I got
Are you decorated? Look at that.
mini Christmas tree ready to go.
You have to wait till after
Remembrance Day.
Remembrance Day. Yeah,
That's right.
which is I can't believe it's already like the time just goes like
Fast.
it's
Real
crazy.
fast. Real
I
fast.
can't believe it. My mom, was calling me the other day asking about what I'm
Christmas.
doing for Christmas. It's like, whoa,
Whoa,
it's
whoa,
not
whoa,
there
whoa.
yet. So a couple questions, we'll get these in.
Okay, let's do it.
This
Speed
is
round.
very vague. Any speed round, I like that. Any advice or general thinkings to keep an eye on going forward?
Yeah, pay your debts. Pay your debts. Mind your P's and Q's when it comes to expenses. It's going to get really, really, really tough.
I'll second that. I think really look at your costs every month. Take your credit card bill or your bank statement every month. Go through it and literally go, what is this? What is this? What is this? Why did I buy this? Why did I buy that?
100%.
And try and cut it out.
I got goofed on because I told people to actually print, like on paper, print out their bank statements and go through with a highlighter. And tons of people gave me feedback like, well, they have apps for that now. Let me tell you something. You'll ignore the app. You have 5 fitness apps on your phone right now. You're overweight. Okay. Like I'm speaking about myself as well. Just print out the 3-month statements, sit down with your coffee on a Saturday morning and put a yellow highlighter through the BS purchases that you've made and just count them up. That's all I'm going to say, because you'll be shocked. You'll be shocked. Don't use the app, print out the statements, highlight them.
Okay, question. I love these speed rounds. This is great. From Zach. So for someone who's 23, not financial advice, obviously, but would you prioritize getting into the market right away at a younger age, or rather put the money into, for example, an ETF and buy it at a later time? He doesn't mind renting, to be honest. So,
man, that's a really good question. Here's what I'm going to say. If I was 20, okay, you answer it, Scott.
Okay, no, I would say. I'll leave his question up there. Sorry.
Yeah, leave it up.
I wouldn't necessarily. So I guess we'll look at time frame, Zach. Right? When you thinking of buying, there's always that big thing. I'm a big believer if you have a savings or you have a savings for a home, you shouldn't risk that overly in the market. Whether you plan to buy even in 10 years, I think you should be, obviously my personal opinion is to be more on the conservative side with your investing, because the last thing you want to do is have a down payment for a house and then all of a sudden something comes up or you want to buy and your portfolio is down even 5 or 10%, which doesn't seem like a lot these days, right? I would look right now, if any investor or someone saving for a home, TFSAs are great. There's the RSP. You can have the RSP thing, but don't forget with the TFSA, you don't have to pay it back if you take it out, which is a good thing for cash flow, because with the RSP, you do have to pay that back, right? In order to avoid the tax. Check out GIC. Look at GICs. If you can put your house savings, I think, into a shorter, like if you're planning to buy in the next 1 to 3 years, look at shorter term GICs. You're making 5% and not having to worry where it's going to be. That's my 2 cents.
Okay, good 2 cents. Here's my 2 cents. You're 23. Chances are you don't have any kids. Chances are you're not married. I would seriously consider watching the market as it starts to come, as it starts to approach a bottom. I'd seriously keep an eye out for triplexes and up. So 3 unit, 4 unit, 5 unit plus. 5 unit plus in mortgage financing, you would actually only qualify, generally speaking, on the rent rolls, not your income. So you start to get into like a quasi commercial residential financing. And the reason I'm going down this path is one of those units you can occupy as an owner occupied property, right? It's a smaller unit, generally speaking. The other 2 units can help you pay your mortgage off. So when you're net out of that property and you're going to be living in it, which is a little harder for people to stiff you on rent when they're living right next door to you. You know what I mean? Reason being, you might find a good deal as rates are higher, but values start to come down. And also, it's a great stepping stone. Instead of buying a 1-bedroom condo that you can only rent out one of those, it itself, or have to sell it. If you start with a triplex or a multi-unit, this sounds crazy, but if you can manage to use that money to put that money to good use and buy a multi-unit, you can occupy one of those suites. And then when it's time for you to move out, when you've met somebody or you just get tired of living there, you just put a renter into your place. And now you have a fully functioning, cash flowing multi-unit as you make that step to the next property.
There you go.
That's what I would do if I was 23 again and have nothing to do but make money and work and save money. That's what I would do.
The good old days. So anyways, yeah, so Zach is a little bit different. This is where everybody's different, right? He does always max out his registered accounts. So he's trying to save for the house afterwards. So if you do have a bit of a nest egg in your TFSA and in your registered accounts, depending what the investments are, you can maybe afford to be a little bit riskier on other stuff. Everybody's different. I guess this is where kind of we'll leave it off, is everybody should have somebody that they talk to about investments, whether that's a financial planner, a banker, or even smarter people on YouTube. Do your research on any type of investment. In the house is an investment. So
that's right.
I guess if anybody, we'll sign off because we're coming up at the end of the hour. Thanks everybody for tuning in. This was a good one. Lots of questions as always, and it's always good to have a different face on instead of my mug. Thanks, Rob, for spending an hour of your time this morning on the channel. Hopefully you enjoyed it.
I did. Yeah. Thanks for having me on.
We swear less when we talk live than if we're actually talking on the phone. But
allegedly,
we've been good. So yeah, thanks, Zach. It was great to have you on. If anybody has any other questions, if they're watching this video when it's recorded, it'll be up. Leave a comment and we'll try to get back to you or pass it over to Rob. I guess the best thing I could say, Rob, I'll put your link to your website in the description down below the video. So if people want to get in touch with Rob about a mortgage in Ontario or Guelph, most importantly, I think would probably be fair to say, his contact information will be there. So you can reach out. And if you have other follow-up questions, you're probably more than happy to answer.
Super. Thank you very much, Scott. Thanks for having me on.
Thanks everybody for watching. Let everybody go. Thanks, and we'll have a great day. See you tomorrow.
Cool.